Alternative investment allocation requires a comprehensive evaluation of how these assets contribute to portfolio objectives and overall risk management. Investors typically allocate to alternative investments to enhance diversification, improve expected returns, access unique risk premia, and protect against inflation. However, allocation decisions must extend beyond expected performance and consider the distinct characteristics of each alternative asset class. Private equity, hedge funds, real estate, infrastructure, commodities, and private credit possess different return drivers, liquidity profiles, risk exposures, and operational requirements. Portfolio managers must understand these characteristics when determining allocation levels. Successful allocation involves balancing potential benefits against the additional complexity and risks associated with incorporating alternatives into a diversified investment portfolio. An important consideration in alternative investment allocation is the relationship between expected return and risk. Alternative assets often provide exposure to risks that differ from those of traditional equities and bonds, creating opportunities for improved portfolio efficiency. Private equity may offer higher long-term return potential through active ownership and operational improvements, while real assets may provide protection against inflationary pressures. Hedge funds may deliver returns through manager skill and market inefficiencies rather than broad market appreciation. Nevertheless, these opportunities frequently involve greater uncertainty, valuation complexity, and manager dependence. Investors must therefore assess whether anticipated returns adequately compensate for the additional risks, costs, and governance requirements associated with alternative investment programs. Investor-specific circumstances play a crucial role in determining the suitability of alternative investments. Suitability depends on factors including investment horizon, liquidity requirements, risk tolerance, financial objectives, and governance capabilities. Investors with long-term horizons and limited liquidity needs are generally better positioned to tolerate the illiquidity associated with private equity, private credit, and infrastructure investments. Conversely, investors requiring frequent access to capital may find highly illiquid strategies unsuitable despite attractive return expectations. Risk tolerance is equally important because alternative investments may experience periods of significant volatility or valuation uncertainty. As a result, portfolio managers must align alternative investment allocations with both the financial capacity and psychological willingness of investors to accept risk. The investment horizon is particularly important when evaluating alternative investment suitability. Many alternative assets require capital commitments extending over several years before investment objectives are fully realized. Private equity funds, for example, often operate under long lockup periods and depend on gradual value creation before exits occur. Real estate and infrastructure investments similarly benefit from extended holding periods that allow operational improvements and income generation to materialize. Investors with shorter horizons may be forced to liquidate positions under unfavorable conditions or may be unable to access capital when needed. Consequently, alternative investments are generally most appropriate for investors capable of maintaining long-term commitments and tolerating temporary illiquidity. Several approaches can be used when allocating capital to alternative investments. Traditional asset allocation frameworks incorporate alternatives as separate asset classes alongside equities and fixed income. More advanced approaches focus on underlying risk factors rather than asset classifications. Factor-based allocation seeks exposure to specific sources of return, such as inflation sensitivity, illiquidity premiums, economic growth, or market inefficiencies. Some investors utilize strategic allocations designed to remain relatively stable over time, while others employ tactical allocations that adjust exposures in response to changing market conditions. Regardless of methodology, effective allocation requires a thorough understanding of how alternative investments interact with other portfolio holdings and contribute to overall portfolio objectives. Liquidity planning is one of the most critical aspects of alternative investment management. Many alternative assets are characterized by limited liquidity, infrequent trading, and extended capital commitment periods. Investors must carefully evaluate future cash flow needs before committing capital to illiquid investments. Failure to maintain sufficient liquidity reserves may force investors to sell assets at distressed prices or forego attractive investment opportunities. Liquidity management involves forecasting capital calls, expected distributions, spending requirements, and potential market stress scenarios. Institutional investors often maintain dedicated liquidity reserves or liquid asset allocations to support alternative investment programs. Effective liquidity planning enhances portfolio resilience and reduces the risk of financial strain during adverse market conditions. Monitoring alternative investment programs presents unique challenges compared with traditional asset classes. Because alternative investments are often less transparent and less frequently valued, investors must rely on detailed reporting, manager communication, and ongoing due diligence. Performance evaluation should consider not only returns but also risk exposures, portfolio diversification benefits, operational effectiveness, and adherence to stated investment strategies. Monitoring also includes assessing manager performance, organizational stability, governance quality, and changes in market conditions. Since alternative investments often involve specialized expertise, investors must establish robust oversight processes and ensure that investment decisions remain aligned with long-term objectives and risk management requirements. A successful alternative investment program integrates suitability analysis, allocation methodology, liquidity management, and ongoing monitoring into a coherent portfolio framework. Alternative investments can provide meaningful diversification, enhanced return opportunities, and access to unique risk factors unavailable through traditional markets. However, these benefits can only be realized when allocations are tailored to investor circumstances and supported by strong governance practices. Effective implementation requires balancing expected rewards against liquidity constraints, operational complexity, and risk considerations. For CFA candidates, understanding the considerations involved in allocating to alternative investments is essential because these assets have become increasingly important components of institutional and private wealth portfolios, influencing both strategic asset allocation and long-term investment success.